Stock market volatility is back, but this time bonds are the shock absorber for portfolios. Good morning and welcome back to Morning Markets. Now, in our week ahead, we'd normally focus in mostly on the data which is expected to be released over the next 5 days. But let's just recap the end of last week, where we saw some unusual market volatility in equity prices, and in fact this is carried through into early opening hours today. What's driving this sentiment really is a fear that the US economy is slowing, with some adverse reaction to the fact the US Federal Reserve did not cut interest rates on Wednesday, unlike the Bank of England, who surprised on the following day with an interest rate cut. What compounded some of the volatility towards the end of last week was an unusually weak print in the monthly US manufacturing survey of employers. The employment subcomponent of that index fell 6 points. Now, it's already been in contraction for most of the last year. However, markets are worried about the size of the move, particularly if it follows through to the services-based equivalent, which is going to be released this afternoon. It's more important that we focus on today's services-based survey because the US economy is somewhere around 70% services-driven. Now, this survey has already been indicating a slowdown ongoing in the US economy for some time, and also that employment intentions have been cooling as well, and this has been matched by the data we've seen recently. However, markets are looking through this and fearing that we'll actually see a larger decrease in the employment component than would be acceptable. The fear is here really that the US Federal Reserve simply have monetary policy too tight, given inflation is falling back to target and there is a cooling in the jobs market. And we're seeing wider indications of disinflation. Underlying US inflation, excluding growth in rents, is actually below 2%. And we're seeing wage growth, which is around about 4%, and it's actually continuing to fall. So there is room for the Federal Reserve to cut rates, but they chose not to. So the market is looking through this and fearing that simply the economy is cooling quicker than the US Federal Reserve can react to. So that's the main release for the next few days. It's actually quite a quiet week. We're not going to hear from any central banks following the Bank of England last Thursday, and in fact they do intend to take the month off. However, markets are being a bit volatile, so there's an outside chance that we may hear from one or two central bankers this week. Where we end the week will be with Chinese inflation data. Recall that China has not had the inflation boost that the global West has experienced the last 2.5 years, but it is actually fighting deflation. That is the risk of falling prices. If July's print, released at the end of this week, comes in line with market consensus, it will be a negative 0.2% for the month of July. That would tell us that 6 of the last 12 months of Chinese inflation data have actually shown a fall in prices. And in fact, the overall economy would be in deflation if it were not for a very unusual spike in inflation prices following the new year in February. So two cross currents here, China fighting deflation and the West seeing a normalising economy, but worried that interest rates are just a little bit too high given the cooling in the economy. There's much room for central banks to cut rates. They just chose to delay it a little bit. So please do join us tomorrow, where my colleagues will update you on the services-based data from the US. Thank you.